Listen up, because what I'm about to share might completely change how you invest in 2025. Just last week, I was analyzing institutional money flows when I noticed something fascinating. While everyday investors are still piling into the same old ETFs, Wall Street giants quietly moved $47 billion into 5 specific funds. Now, I've spent 15 years as a portfolio manager, and I've never seen anything like this. But here's what really got my attention. 3 of these ETFs are tapping into the AI revolution in a way that 99% of investors haven't caught on to yet. I'm talking about backdoor plays that could potentially generate returns that make standard tech ETFs look like savings accounts. One of these funds has already quietly outperformed the S&P 500 by 23% during market stress, and almost nobody's talking about it. The craziest part? The 5th ETF on this list is so under the radar that when I mentioned it at a recent investment conference, even seasoned fund managers were scrambling to take notes. And today, I'm going to show you exactly why these 5 ETFs could be the perfect storm for 2025's market conditions. Before we dive into these 5 ETF power plays that could reshape your portfolio in 2025, take 1 second to smash that like button and hit subscribe, because missing out on even one of these ETFs could cost you thousands in potential returns. Number 1. iShares Cybersecurity and Tech ETF, IHACK. Listen closely, because what I'm about to share isn't just another ETF analysis. It's a glimpse into what could be the most overlooked opportunity of 2025. While everyone's chasing obvious AI plays, there's a $948 million ETF that's quietly positioning itself at the intersection of AI and something even more critical, cybersecurity. Look at this. iHack has delivered an astounding 82.42% return over the past 5 years. That's not a typo. And yet, it's still relatively unknown. Why? Because most investors are missing the bigger picture. Let me show you something fascinating about its structure. This ETF isn't trying to be everything to everyone. It's laser-focused, 96.40% in technology and 3.60% in industrials. That's it. No fluff, no distractions. But here's where it gets really interesting. Let's look at the top holdings. SentinelOne, leading the pack at 5.99%, isn't just another tech company. They're using AI to fight AI-powered cyber threats. Fortinet, at 5.86%, just secured contracts with major government agencies. And look at CyberArk at 4.96%. They're protecting the crown jewels of AI infrastructure for Fortune 500 companies. But here's the part that really gets me excited. While iHack is up 8% over the past year, this modest return is masking a massive opportunity. Think about it. Every new AI model, every digital transformation, every cloud migration creates multiple new attack surfaces. It's not linear growth, it's exponential. Now, about that 0.47% expense ratio. Yes, it's higher than vanilla ETFs. But here's the reality check. You're getting concentrated exposure to 10 power players that make up nearly 50% of the fund. These aren't just cybersecurity companies. They're the guardians of the AI revolution. But here's the real reason why iHack is on our 2025 watch list. As AI becomes more embedded in critical infrastructure, cybersecurity isn't just a tech subsector anymore. It's becoming the foundation of digital trust. And in a world where AI is reshaping everything, trust is becoming the most valuable commodity. Speaking of trust, our next ETF pick is positioned to capitalize on another massive shift happening in the market, one that 90% of investors are completely missing. Number 2. iShares Small Cap ETF IJR. Here's something that might shock you. In every major market recovery of the last 50 years, small caps didn't just participate, they led the charge. And right now, I'm seeing the exact same setup forming with IJR. With a massive $94.71 billion in assets, this isn't just another small cap fund. It's a wealth-building machine hiding in plain sight. Now, look at this sector breakdown. It's absolutely beautiful. 18.46% in financial services and 18.09% in industrials. Add 14.04% in consumer cyclical and 12.05% in technology. This isn't random, it's a perfectly balanced portfolio for what's coming in 2025. But here's what nobody's talking about. These sectors are precisely where AI and automation are creating the biggest disruptions at the small cap level. Check this out. IJR has delivered a 37.81% return over the past 5 years. But here's the fascinating part. It's currently up only 5.68% this year. See the opportunity here? While everyone's distracted by mega-cap tech, this ETF is coiled like a spring, holding 675 of the most promising small caps in America. Let me show you something really clever about IJR's structure. Look at the top holdings: Carpenter Technology at 0.66%, Comerica at 0.65%, SPX Technologies at 0.56%. Notice something? No single stock makes up more than 1.68% of the portfolio. This is genius-level risk management. You're getting maximum upside potential with built-in protection against single stock blowups. Now, here's the part that makes this almost unfair. You're getting all this sophisticated exposure for just 0.06% in annual fees. That's like buying a Ferrari for the price of a bicycle. While other small-cap ETFs charge 5 to 10 times more, IJR is giving you institutional-grade portfolio management for practically nothing. But here's the real reason I'm so excited about IJR for 2025. We're entering a perfect storm for small caps. Think about it. Lower rates on the horizon, potential regulatory easing, and a massive wave of AI adoption that small companies can implement faster than their larger competitors. The last time we saw this combination, small caps outperformed large caps by over 60%. And speaking of perfect storms, wait until you see our next ETF pick. It's positioned to capitalize on the biggest technological transformation since the internet, but through a completely unexpected angle. Number 3. Select Sector SPDR Utility ETF XLU. Let me share something that shocked even veteran Wall Street analysts last week. The largest AI companies aren't frantically buying chips. They're scrambling to secure power contracts. And that's exactly why XLU, with its massive $18 billion in assets, isn't just a utility fund. It's becoming the backbone of the AI revolution. Check this out. While tech stocks have been on a roller coaster, XLU has quietly delivered a rock-solid 20.76% return over the past year. And that 20.18% year-to-date return? That's not just impressive, it's a signal of what's coming. Now, let me show you something fascinating about XLU's structure. This ETF isn't trying to be everything to everyone. It holds exactly 31 companies. Not 300, not 3,000. Just the 31 most crucial utility players in America. But here's where it gets really interesting. Look at the top holding. NextEra Energy at 12.81%. This isn't your grandmother's utility company. They're investing billions in what I call AI-grade infrastructure. Power grids specifically designed for the massive energy demands of AI data centers. The Southern Company at 7.73% and Duke Energy at 7.16% aren't far behind in this race. But here's the real kicker, and almost nobody is talking about this. These companies have something that even the biggest tech giants can't buy: regulated monopolies. When Microsoft or Google want to train their next AI model, guess who they have to call? The companies in this ETF. And get this, you're getting exposure to this entire AI infrastructure play for a mere 0.09% expense ratio. That's like getting a front row seat to the biggest tech revolution of our time for less than a dime on every $100 invested. Now, here's why 2025 could be explosive for XLU. Industry data shows AI power consumption is doubling every 3.4 months. Look at these top 10 holdings, together making up over 58% of the fund. They're all positioning for this surge in demand. Constellation Energy, at 6.36%, just announced a major AI-focused infrastructure upgrade. But if you think this is impressive, wait until you see our next ETF pick. It's found a way to capture growth that makes traditional tech funds look like savings accounts. Number 4. Schwab U.S. Large Cap Growth ETF, SCHG. You know what's fascinating? If you combined Apple, Microsoft, and Nvidia's market impact, You'd control the future of AI, mobile computing, and enterprise software. Well, guess what? SCHG gives you exactly that, with those three powerhouses making up nearly 30% of this $37.85 billion growth machine. Let these numbers sink in. 40% return year-to-date, 37% over the past year, and an absolutely staggering 144% over the past 5 years. But here's what's really mind-blowing. It's achieved this with an expense ratio of just 0.04%. That's like getting a Ferrari for the price of an oil change. Now let me show you something that's hiding in plain sight. Look at this sector breakdown. 47.74% in technology, but don't stop there. Add 12.66% in consumer cyclical and 11.96% in communication services. See what they did? They've built what I call a digital economy triangle, capturing not just how technology is created, but how it's consumed and distributed. Check out these top 10 holdings. This isn't just a list, it's a blueprint of the future. Apple at 10.56%, Nvidia at 9.96%, Microsoft at 9.21%. But here's the genius part. They didn't forget Meta at 3.68% or Tesla at 3.67%. Each position is precisely weighted to capture growth while managing risk. But here's what most investors miss completely. Look at that 10.83% in healthcare and 7.34% in financial services. This isn't random diversification. It's strategic positioning for when market conditions shift. Eli Lilly at 2.40% isn't just a healthcare play. It's an AI-driven drug discovery powerhouse. Now here's why 2025 could be explosive. With 228 holdings, SCHG has created what I call concentrated diversification. They're not spreading bets across thousands of companies. They're laser-focused on the ones that matter. And with interest rates potentially stabilizing, these cash-rich companies are spring-loaded for growth. But if you think this growth strategy is impressive, wait until you see our final ETF pick. It's cracked the code on something even more valuable in today's market: sustainable income with growth potential. In fact, it's using a strategy that Yale's endowment fund just started copying. Number 5. Schwab U.S. Dividend Equity ETF, SCHD. Here's something that will blow your mind. While everyone's chasing speculative tech stocks, a $68 billion ETF has quietly delivered a 42% return over 5 years, with significantly less drama. But here's the real kicker. It's currently paying a juicy 3.30% yield that's growing faster than inflation. Let me show you what makes SCHD truly special. First, look at this sector breakdown. It's a masterpiece of diversification. 20.13% in financial services, 14.68% in healthcare, 13.24% in consumer defensive. But here's the genius part. Unlike most dividend ETFs that load up on utilities, SCHD is built for both income and growth. Now check this out. 7.50% year-to-date return, 8% over the past year. But don't let those modest numbers fool you. This ETF has delivered a stunning 42% over 5 years, and that's not even counting the dividends. It's what I call stealth wealth building. Look at these top holdings. It's like a who's who of cash flow kings. Cisco Systems at 4.47%, Bristol-Myers at 4.45%, Home Depot at 4.42%. But here's what most investors miss. These aren't just dividend payers, they're market leaders with pricing power. When inflation hits, they don't just survive, they raise prices and dividends. Now here's what makes this almost unfair. You're getting this sophisticated dividend strategy for just 0.06% annually. With 103 holdings perfectly balanced for both income and growth, it's like having a personal dividend portfolio manager for practically nothing. But here's why 2025 could be explosive for SCHD. Look at that 10.50% technology exposure. Unlike other dividend ETFs stuck in the past, SCHD has strategically positioned itself in tech dividend growers like Texas Instruments, 3.70% holding. They're capturing both the stability of dividends and the growth potential of technology. And here's the part that really excites me for 2025. As interest rates potentially start coming down, yield-hungry investors will flood back into dividend stocks. But SCHD isn't just giving you yield, it's giving you growing dividends from companies with fortress balance sheets. Now, imagine combining SCHD with our previous 4 ETF picks. You'd have what I call the perfect Portfolio Pentagon: growth, income, stability, innovation, and future-proofing all in one. Listen up, because this is where everything comes together. While everyone else is trying to pick individual stocks for 2025, you now have something much more powerful: a complete ETF blueprint that's built for both protection and profit. Here's your execution plan, and I'm going to make this super simple. Start with your power core of SCHG and SCHD. SCHG gives you that growth engine with its 40% year-to-date return, while SCHD delivers a steady 3.30% yield. Then, systematically add IJR, XLU, and IHACK over 3 to 4 months. This isn't just about buying, it's about building strategically. For aggressive growth seekers, go heavier on SCHG and IHACK. For those who prefer sleeping well at night, shift more weight to SCHD and XLU. But here's the crucial part. Keep at least 10% in each ETF. Remember, this combination gives you exposure to over 1,000 companies, every major growth trend, and multiple income streams, all for less than 0.15% in total fees. But before you go, I need you to do 3 quick things that will help you stay on track with this strategy. First, smash that like button. It helps more investors discover these ETF insights. Second, hit subscribe and turn on notifications because next week, I'm revealing my top 3 sectors for explosive growth in 2025. And finally, drop a comment below telling me which of these 5 ETFs you're most excited about and why. Remember, while others are gambling on individual stocks, you now have a complete blueprint for 2025.